Hello, welcome to Corporate Finance class. And it's going to be a 10 module course. Today we'll be looking into an introduction to corporate finance. We take look at the basic concepts and basic aspects of corporate finance. And for this module, we will talk about the definition, the scope, and objectives of corporate finance. We look at the relationship with financial management and accounting, and also we look at the role of corporate finance in business decision making. What is corporate finance? Corporate finance is the framework for how firms raise, allocate, and manage financial resources. And looking at it from the angle of Braley, Meyer, and Harlan, 2019, corporate finance deals with the financial decision that business enterprises make and the tools and analysis used to make these decisions. Also, looking at it from that of the Rose, Westerfield, and Jaffe, they define corporate finance as the study of the relationship between business decisions and the value of the firm's security. And with this, it actually blends theory with practical to bridge the gap between financial decision and a company's long-term growth and sustainability. And unlike the personal or public finance, it's specifically focused on maximizing value for owners and stakeholders. And the central hub, it's a central hub for answering the following questions. The first is, what long-term investment should the firm make? Also, how should this investment be financed? And lastly, how should profit be distributed by shareholders? We have three core pillars of corporate finance, and for this, the discipline is built on three core decision areas, which is the investment, financing, and dividend aspects. They deal with investment, financing, and dividend. And we will look at this one after the other. The first one is the investment decision, and this is actually known as the capital budgeting. It involves allocating a firm's capital to long-term projects, and it's about evaluating the potential risk and return of such a project. An example of investment decision or capital budgeting is deciding whether to build a new factory or upgrade the technologies that are being used. And the key tools that are used in terms of this investment decision or capital budgeting are the NPV, net present value, the internal rate of return, which is the IRR, and the payback period. We have the second pillar of corporate finance, which is the financing decision, and this deals with the capital structure. And we will deal with this one after the other. So this is just a brief of it. And when we talk about the financing decision, this focuses on how a firm raises fund for its investment, and the main goal is to find the optimal mix of debt and equity to minimize the cost of capital. An example of this is choosing to finance an expansion by issuing new shares or taking on debt. And the last is the dividend decision, which is also known as a profit distribution. And this determines how profits are split between paying dividends to shareholders and retaining earnings for reinvestment, and it impacts both investor satisfaction and company's long-term growth. Example of this is deciding whether to issue a cash dividend to the investors or to invest all earnings back into the company for more profit as such. We have the primary objective of corporate finance, and when we talk about that, the main essence for corporate finance is actually maximizing of shareholders' wealth. The main goal of corporate finance is maximizing of shareholders' wealth, and this is achieved by making decisions that increase the market value of the firm's share. Also, shareholders' wealth maximization is different from simple profit maximization, and because it considers one, the risk of a decision, two, the timing of return, and three, the long-term sustainability of the firm. Looking at corporate finance and some other discipline. For this, we'll be looking at the financial management, and also look it in terms of the accounting part. When we look at it from the financial management, corporate finance actually sets the strategic direction, which is the what, and it makes decision about what project to fund. However, looking at the financial management, it actually focuses on operational execution, which is the how of it, and it ensures that the company has enough liquidity for daily operation. And for corporate finance and accounting, looking at that of accounting, it's a past oriented discipline that records and reports financial transactions, and it provides the financial data needed by the organization. And this is actually also useful for decision making because it helps investors to be able to decide if to know what, the performance, to be able to know the performance of such an organization, and if perhaps to invest in such an organization. And looking at the corporate finance, it's a future-oriented discipline that interprets accounting data to make forward-looking decisions about value creation. The role of corporate finance in business decision, corporate finance acts as a strategic compass and a decision-making tool. And in terms of its role, it can be seen in terms of investment decision, financing decision, dividend decision, and risk management. For the investment decision, it's the use of tools like NPV and IRR to ensure resources are invested in value maximizing projects. And for the financing decision, it helps companies balance debt and equity to minimize the cost of capital and enhance firm value. And as per the dividend decision, it guides the balance between paying dividend to investors and retaining profit for growth. And for risk management, it equips manager with techniques to mitigate risk like fluctuating investment interest rate and volatility. So yeah, it plays corporate finance plays a role. In business decision in this aspect of the decision making of an organization. We also have the broader objective of role also in terms of valuation, which talks about corporate finance is essential for valuing assets, investment, and entire business, which informs strategic decision like merger and acquisition. Also, it's in terms of corporate governance, corporate finance helps ensure that financial decisions are transparent and aligns with the interest of shareholders. And as per the resource optimization, corporate finance is seen as a discipline that aims to use financial and non-financial resources efficiently to generate the highest return. And lastly, stakeholders value. And this talks about modern corporate finance, which recognizes the need to create value for all stakeholders and not just the shareholders. In conclusion, corporate finance is the essential analytical engine for strategic business decision, and it integrates past financial data present operational execution, and future strategic goal. And by guiding investment, financing, and decision dividend policy, it helps business thrive in competitive global environment. Thank you.